Peter Rose, Longwood Currency Trading. It's the end of November of 2021, and timing is everything. That's what I'd like to talk with you a little bit about today, and it's kind of out of my normal current publishing schedule, Tuesdays and Thursdays, but being the end of November and going into December, I'm not sure how much trading I'm going to get done in December because of family coming in to visit and all the other stuff that happens in December, and the markets as a result of that are pretty flat, so I doubt that I'll be trading too much. So I thought I'd give you an update on where I've found my weaknesses over the past year and how I've been able to overcome those weaknesses, because in the last I think 13 days that I've closed trades, I'm up about $13,000 now, and running about 15% on risk for the year. The reason I bring that up is simply because in a lot of the videos that I've done throughout the course of the year, I've been very upfront about where I've been in my trading on any given time. Sometimes it's a good thing, and sometimes I'm saying, geez, I'm underwater, 3,000 bucks here on this trade, I don't know what's going to happen. And then I tend not to get back with an update on that, because these videos aren't chronological in any manner. They form no significance in any kind of chronological order. So I find it of little value or benefit to update on a weekly or monthly basis on how I'm doing. I think it's more important to talk about what I'm doing in a given particular period and what's happening, so that you kind of get a balance of understanding of how trading flows over the long term. And having trades that are underwater is indicative of carry trades, which I try not to do. Although I've made a lot of money on carry trades at the 13,000, I think that I made this past 13 trades or so. I think most of them were carries for a day or two anyway. A couple of them were 10 days. And again, I would have a much higher percentage yearly gain on risk if I wasn't taking a $6,000 gain over a 10-day period of time, and then you divide the $600 and you get 1% on risk, which is really good. I mean, in the last nine or so trading days, I've averaged 1.7% on risk, so that's pretty good. And I haven't had a losing trade in 13 trades. I had 3 losers before that, and then I had a run of about another 8 or 10 winners. So my win to loss as far as daily results is really, really good. On a per trade basis, that's going to fluctuate because during the course of a day, I might take 3 or 4 trades, and maybe 2 of them are going to lose, or and I'll win one and make up the difference. And like in was it October or September or something like that, I had a $56 month, but it counts, That was a $56, not $5,600. That was $56 for the whole month. And as a result of that, there were a couple of carry trades that I got whacked on. And I had to build up some capital from there, and I was able to scrape out the $56 win for the month. So I mean, that'll buy dinner and a cup of coffee. I think maybe that's all that's going to do. But I guess the topic of timing, which is the critical issue here, not how much money I'm making or anything like that, because the year before I lost $40,000. So, or maybe it was 2 years. I don't remember. It doesn't make any difference to me. It's the process that's important to me, and I think through these last 6 months of working through and seeing that I'm carrying too much underwater gear over too long of a period of time, when I should be exiting right away when the thing goes against me and then stay in there to trade. Now, you do your entry analysis and the thing spikes and goes against you, and it goes way against you, it retraces a little bit, and then it starts to go back against go back against you. And so at that point, if I had got out right away, I would see that and I would jump on the reversal and I'd ride that. I can't tell you how many tens of thousands of dollars of potential profit that I've left on the table because I've been in a carry trade that's gone against me, and I'm sitting there, and eventually the thing does turn around and it goes in my direction. Only at the beginning of the year did I get caught for about $10,000, it was a little more than that, $12,000 of losses, and they were all due to carry trades that I just said, this is stupid. I have to get out of this because it's $6,000-8,000 against me on the one trade, and I lost $5,000 on another one, and it was just unnecessary because each one of those, the reversal, was actually a trend that went literally hundreds of pips. Well, I'm losing hundreds of pips. You take off a 2 lot or a 3 lot, you trade, and so $30 times 100 times 200 pips is $6,000. There's my loss. I could have made $6,000 on that rise, and so I've left literally tens of thousands of dollars on the table because of my decision to do a carry trade. Oh, the thing has gone against me and I'm sure it's going to turn around and go in my favor. Now, of the probably 8 times that I've carried, I've lost $10,000 on 2 or $12,000 on 2, and I've made $15,000 or $20,000 on the rest of them. So there's something to be said there that getting involved in a trade or staying involved in a trade as a carry trade when it goes against you, or even if you're day trading and let the thing go against you, what's the probability that it'll take your 20 pip stop or your 30 pip stop or wherever that is? There's a lot of folks I know that have these long stops, the 20 or 30 pip stops, and they don't ever get hit. Well, the reason they don't get hit is they have a good entry process, and if they're like me, and again I try that, and more often than not, because I'm relaxed on my standards as to taking that immediate loss, it'll go negative, and I'll say, well, I just know this is going to turn around. And that was the case for I closed an $800 trade that I put on yesterday. It was a carry trade. Actually, it was a continuation trade of the one that I had the day before, and the day before that I made, I think, $600 or $800 over the previous 2 days, and then got into this situation where this price is going to collapse. It's just going to collapse. And I picked up a couple of $100 yesterday. I picked up another 150 or so this morning. I could have cashed out, but I said, look, I think this thing is going to go, and when it goes, I want to have some orders in place. And I had those limit orders in place, and the thought was that price would gradually, go down and pick up the 6 lots that I had. I was picking 2s, 2 and 2, so I was trading a $60,000 account, and I figured I'd put the full set in, splattered over 10 or 12 pips, 15 pips, to hit what was going to be probably a 3,700 or something profit target. Well, that's not really what happened. I'm sitting at the desk today, made a couple of trades, closed it out. Like I said, I was up about $150, and then I had closed part of that trade yesterday for 100, 110. So I'm up, 260 or something like that going in to this price as it's floating around, and I do have an active position of say I had 3 lots, and I added on 3 more as I went through, and price just went, and I was just sitting there. I said, I know it's going to be going in my favor. It went $4,000 against me earlier in the day. I guess they're worried about the ramifications of this new Omicron, or whatever you call it, variant on the COVID thing, and the stock market's reacting crappy, and Powell is going to do a Fed banking presentation in Congress or something later today, and everybody's twitty over the dollar right now. And I thought, well, the dollar's going to be okay. It's the pound that I was trading that's not going to be quite so okay. And I figured that spike up earlier today, where I was $4,000 in underwater, was an anomaly, because it was a pretty good sized spike, and it gradually started to come back down, and then I'm like $300 underwater, and I thought, okay, I'm not going to worry about this. Went out and got a cup of coffee. While I'm out, my phone goes bing, bing, bing. I picked up those extra three lots, and then it bing, it hits my stop. So I pulled $700 or $800 off of that, and then bing, bing, it picks up, of these standing orders that I had, it picked up 2 of those. It picked up 2 of them, but the problem was that it was a spike. I mean, price just dropped like a stone, and I thought, wow, man, I'm $400 up here on this. I got a profit target down there of 3,700, but this thing is just there's just a spike, and it's unsustainable. Psh, I'm out. I took another $300 off the table. It was a little less than that, because I ended up the day, I think it was $850 for the day. But I'll tell you what, that downward spike was retracting like crazy, because at one point I was $1,400 up, and it's just started to recover, and I went, I'm out. I'm just having to get out of here. So my timing was wrong, because I had to suffer through a $4,000 loss on paper in order to make $850. That's really upside down and dangerous, because that 4,000 could have easily gone to 8 or 10. And we're coming to the end of the year, and where are you going to get trades that are going to make that much money back for you? So in an overabundance of caution, I got out of that trade, even though it will probably continue down over the course of the next week or so. I said, let's just close out November and have a good day and feel good, and then we'll see what happens in December. But as a day trader, again, my issue is not an issue that you would particularly face, because I came out of the real estate investment environment. I have 40 years in real estate investing, and your risk analysis is totally different, and the time that you carry risk is a long time, but then you make it up and you compound and you do all this stuff. I've lost $1 million twice in my life I've made it back each time. I never lost the underlying assets. I lost net worth. In other words, my net worth went went to zero from $1 million twice. But I still had the underlying assets because my leverage was good, and I understand the game. And it's very difficult for me to break the 40 years of how you manage your risk in real estate and apply that into a day trade environment. In a real estate environment, you're safe in the long term, you're not so safe in the short term. In currency trading, I feel it's exactly the opposite. You're safe in the short term and not so safe in the long term. Because how much of a retracement are you going to withstand before you get out? And if you get out way below where your profit target was and you do scoop up some profit, the risk that you're taking in order to make that profit divided by the number of days that's into that profit, you're just not making enough money for when you do get stopped out. I think it's very difficult for the retail trader to do that. My opinion. Don't listen to me, because I've lost tens of thousands of dollars. I've also made tens of thousands of dollars. And what I'm finding in my own little Ed, I've told you about Ed, the little bridge troll that sits on my left shoulder. Yeah, Ed whispers in my ear all the time to do stupid shit. And when I listen to Ed, it ends up being a carry trade. It ends up, I'll just take that 20 pip stop level and it'll never get there. It'll turn around and go back, and it doesn't. It hits a 20 pip stop, and I'm $60,000 into the thing on a 6 lot, and I'm stupid, and I have to work very, very, very hard, harder than I would like to work, in order to make that money back. When I could simply get out a short and then get back in, or take the other side of the trade. It's amazing how many times you can do a reasonable, probabilistic entry analysis and have the timing totally wrong and have the initial direction totally wrong. Whereas if you just waited, I always let the price come to me on the entry. I don't just go, okay, I'm in. Very rarely will I market order my way in. But on the occasions that those things do turn around and go against me, I'll bet you I know for a fact over hundreds and hundreds and hundreds of trades that I do a year, I know for a fact that I wish that I would have taken the painful 8 pip or 10 pip stop rather than waiting for it to go out 20, 30, or 40 pips before I go. I don't believe in setting risk and reward points. I'm a price action trader. I look at what my potential profit target is, and as long as I have a good probability estimate that the price has the juju to continue upward, for example, toward my profit target as opposed to getting hit with the stop, I'll take the trade. When I am careful about that analysis, I get I go to profit on the trade. Now, I might just get out with a 5 pip profit on one lot or 2 lots and let the rest ride, and those come back and go to break even. Or sometimes, like a dumb ass, I just let them go. I don't have the stop there because I figure, well, how far down is it going to go? My entry was correct. I don't want to set a short stop because I need to give that price room to breathe. That some bitch should go right down on through, wipe out the 5 pip or whatever profit that I took on the 1 or the 2 lots, and the rest of them go down 20 or 30 pips and I'm out. I don't like to lose. I've never lost money in real estate. I used to do real estate finance, high risk finance. I never lost a deal on a mortgage. I never lost money in real estate, never. And so it's it's very difficult for me to have a winner and then end up having to go out because I'm going to lose those gains. They're not my gains, you know. Until I close the whole trade out, I don't own it. If I have a winner and I close it, I got a winner. If I go to loss and I close it out, I got a loss. But until then, if I don't close it out, I don't have a loser, or I don't have a winner either. So as long as I don't close the trade out, I don't have a loss. Now, some people will have the ability to, and I could do this as well, and I've done it before, but it's more difficult in the United States that as the trade goes against you, you stage in a little bit as it goes against you, and then as the price comes back up, it takes those out, and then you can close those out. But that's not what happens in the United States because of our FIFO rules. If you take in more trades here as price is going down, you have a long position, it's going against you, so you're adding to that long position. And even if it continues to go down, these latter moves that you took in have very little at risk to where you finally close out. That's the rationale behind that, right? But you can't do that in the United States because as that thing starts to go back up, if you close one or two lots, they're not these lots that you just picked up where you're making some profit to reduce your taking point. Those lots come off up here. And so the FIFO rule just really causes a lot of problems for traders in the U.S. You have to do your staging in a different manner. And I've talked a little bit about doing that on other videos, and I've come out very successful on that. I've come out of heavily losing trades to make thousands and thousands of dollars. But it's very dangerous to do that. It's much better just to take the loss up front. If you have a 20 or 30 pip stop and you keep getting your entry wrong and it keeps going against you, and you're waiting for the sumbitch to come back, and it hits the 20 pip stop, and you don't have a very strong win to loss ratio, and then when you do have a winner, you cut that short a little bit, you're not going to make any money. You just can't. From a mathematical standpoint, you can't. I got a degree in physics. I'm very well steeped in mathematics, and I understand probabilities. I understand risk, and I'm just telling you, that stuff doesn't work. My issue and my problem when I lose is not because of the trading, it's because of the emotional structure that I built up over 40 years of real estate investment, where you just don't do that in the currency markets. It's very difficult for me to break that habit. You know, that's why I'm so interested when people are asking me, can you give me some advice or whatever? Well, what do you do? You know, how old are you? What do you do for work? You know, what have you done in the past? Because I got to know where your reference frames are before I'm going to say something. If you're somebody with an inordinate amount of patience, I'm not going to be able to help you out in trading because I'm a day trader. That big crash was just the snow sliding off my metal roof. We had a snowstorm the other night, and I got a couple inches of snow on the roof. And this is the first year I've had a metal roof. And they all said, don't stand under the roof when the snow starts to melt because it's just going to go. And that's what it's doing today. It's warming up a little bit. Anyway, and I need to know about the person before I offer any advice. If you have a lot of patience, you're not going to be able to understand what I'm trying to tell you in a day trade environment to be able to map that up into the longer time frames. You're not going to see that. You're going to make that connection because you're not going to be paying attention to what I'm saying. And so I try to filter people out that are patient because I'm not sure that you're going to take for value the fact that I can be very patient as well in waiting for an event to happen. I'm just doing it on a day-by-day basis. If I come up to the trading screen in the morning and there doesn't appear to be a trade there, or that could be there just because of where things are, I'm going to go get a cup of coffee and read the news, or do some writing or something. I'm not going to trade. I'll sit there and I'll watch the price action going on, because as long as I'm at my desk, I'm trading. But I'm not looking to make a trade. I'm simply watching the price action to see if an opportunity does develop. Just because you look at the thing right now and there's nothing in the foreseeable future does not necessarily mean that in the foreseeable future a trade opportunity might present itself. And many times I've done that. And quite honestly, that's where I get caught sometimes in these carry trades, because I won't put the trade on until, 11 o'clock in the morning, Eastern U.S. time. Well, that's the time that the U.S. traders are going out to lunch, and over in Europe, everybody's going home. And so, I'll take this great trade, and then it'll just kind of flatline, and I'm sitting there going, well, I'm not going to get any activity on this until 8 or 9 o'clock tonight, so I'll hold it until then. And then it bounces around, it goes a little negative on me. I'm waiting for 8 or 9 o'clock, and it goes back up, and it looks like it's going to be okay. But instead of getting out, I go, well, okay, I'll carry it over. And I wake up in the morning, and I'm a couple of $1,000 down. And then I say, well, that was stupid. I took the trade, so I had a good entry point. That entry point is still valid because the trade has basically gone sideways since then. So it hasn't changed the overall structure because it hasn't done anything. In analyzing a trade, the next price movement could be either up, it could be down, or it could go sideways. And so eventually, if it's going sideways, it's going to go either up or down. And if I've evaluated that price point in the past to be a valid take point, and I've taken my trade at that point, with a probabilistic guesstimate that the price is going to go up, and all it does for the next 12 hours is to flutter on within a 20 or 30 pip channel, 10 pip channel, I got to still feel that I'm right in my evaluation, because nothing has really changed. The left-hand side of the chart doesn't change. It's only seeing changes to the right. And if there's no changes to the right, then what you did on before should still be valid. It's probably not more than a 20 or 30% valid at that point, because the time has changed. You may have different institutional traders that are taking over whatever's going on. You may have those order flows that were large order flows that required a lot of volatility earlier in the day, the previous day, to cause me to want to get into the trade. Those may all be over, so price may just go down because there's no more interest anymore. So, okay, in that pair, we better get out of our current positions, and so everybody jumps on the boat and sells. It's all about the timing. Once you know what to do and how to do it, remember what the next question is? Well, when do you do that? And that's the timing. That's the timing. When do you do this thing? And more importantly, besides when to get in, isn't even more important, when do you get out? Even if you're not negative, if it's just floating along, when do you get out? Or do you get out? Those are important questions. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.